welcome back to the course. In this lecture, we are going to discuss the 5 major principles. These are the most important things. Everything else in financial accounting is based on these principles. They are objectivity, matching principle, accrual basis, conservatism, and reasonableness. Let's go. The first and the most important principle is objectivity. It states that financial statements should represent a true and unbiased picture of the company's business. It's really common sense, because if they don't, they are useless for investors or the board of directors or anyone who can use them. All other principles are derived from the objectivity principle. The second principle is best explained in an example. Suppose you have a company which in year 2023 in November sold something to a customer for say $100. It did everything it was supposed to do in November, but according to the contract, the customer will pay in say March of 2024. What do? How do you record this transaction? In what period do you show the profit from this sale? So you see that everything happened in 2023. That's when the transaction took place, when the efforts were applied. And if you show the result in 2024 and when you actually receive the money, then it will not be fair. For example, in 2024, the company can have different managers who didn't do anything for this sale, and they will be rewarded by additional profit, which is not true and not objective. So the accrual principle states that you should show the transaction in the period when this transaction really took place, and not necessarily in the period when the money traded hands. The next basic principle is the matching principle. Again, it is best explained through an example. Suppose you have a stable business which brings you $200 a month, and your only cost is the office lease. Suppose you paid like $120 monthly, and then your landlord comes to you and says, okay, you know what? If you pay me $1,200 in January, you will not have to pay anything till the end of the year. So your effective cost will be $100 instead of $120. Of course you agree, because it's a good offer, it's a good business decision. But then you will have a large payment in January. What do you do with it? If you register it as a cost in January, and then you calculate your monthly profit for January, it will be like a huge loss. But that is not fair. If you show a huge loss in January and then a better profit for the rest of the year, that's not an objective picture of your business. It is obvious that your business is stable. You get $200 a month in revenues, then you pay $100 a month in cost for your office, and you have a profit of $100. And it is stable. Nothing happened in your business throughout the year. And the objectivity principle says that you have to show an objective picture. In this case, the objective picture is a flat profit of $100 a month throughout the whole year. So the matching principle helps you achieve that by stating that you have to match all your revenues with all costs that have been incurred to achieve those revenues, regardless of when the money has been paid. If you pay the money in advance, that doesn't really matter, because your cost of the office space will still be $100 a month. You just paid it in advance. Therefore, when calculating monthly revenues, you should take into account a portion of the prepayment that you have paid before, a portion applicable to only this month. The next principle is conservatism. What does it mean? Well, further down the course, you will see that accounting is not an exact science. There is room for judgment calls. You will have to make certain decisions, certain estimates that can really affect the financial statements. So the conservatism principle applies mostly to those estimates, and it states that your estimates or judgments should not lead to higher profits on paper. If you're in doubt, play it safe. Go for a more conservative estimate. Maybe it'll understate a profit a little bit, but in any case, it's much better than to overstate a profit. The last principle that we're going to discuss is the basic concept of reasonableness. What does it mean? means that you have to be reasonable and apply common sense to accounting. If the cost of, say, detailed accounting for certain items exceeds the benefit of this, then you should not spend additional money. For example, you buy stationery, pens and paper, everything you need to run your business. Amounts you spend on stationery are rather small, and they will not change anything about your business picture. So it doesn't make sense to account for them as the stationery is used in the business, to account for every pen. The items are so small that it's much more practical to just write them off when you buy them. If it is not reasonable to do some detailed accounting of certain items, then you should not do this, and you can save money. This concept is widely applied by auditors. In order to make their audit cheaper for their customers, for clients, they use so-called materiality principle. Materiality states that financial statements can have certain errors, but those errors should be small and should not change the big picture. In practice, they establish a certain threshold. For example, they can say, okay, our materiality threshold is $1 million. So any matter, the potential error, if it is less than $1 million, we will not investigate it any further. Sometimes this can be quite a large number. For example, if they have an audit of a company with, say, $25 billion in sales, then the materiality can be like $500 million. So while 500 million is a large number, in terms of the financial statements of a very large company, it can be a small number. And if there is a mistake in the financial statements for like $100 or a few $100 million, then it will not change the big picture. So again, it is the application of the objectivity principle. If the financial statements still show an objective picture, they can contain certain small errors. I hope you're still with me. In this lecture, we talked about major accounting principles, such as objectivity, accrual basis, matching principle, conservatism, and reasonableness. I hope you understood what they are, and in the next lecture, we are going to get our hands dirty. We're going to be bookkeepers, registering basic transactions of a small business and its financial ledgers, so you will be able to understand what it means to write down the company's operation into financial accounting ledgers.